Hi, so this is my first video analyzing the stock, and the reason I'm doing this is because I tend to forget everything that I learned about the company, and when I review it within a few months or even years, even when I go through the deep documents I write about it, uh, I don't really remember the sentiment and the feeling I had and my overall big picture impression about the company because it's all fragmented. So I'm trying to record this and see if it helps me within a certain period still remember what I learned and how I felt and how I thought about the company, and that would make it easier for me to review it. So I'm gonna do this probably for all the companies that I'm invested in right now as I review them after a while. I haven't touched or even reviewed my portfolio. So the first one is gonna be Alteryx because it's the one I'm most hesitant about and the most not confident about. So yeah, let's dive in. So Alteryx, I've invested in Alteryx back in 2021, so it's been 2 and something years. And reviewing my investment thesis, it wasn't that bad. It wasn't perfect. I had made some mistakes, and we'll talk about that. But back then, my investment thesis was that it was a really good company. It was a really good product, and it still is. It's a very strong product. It's in its own field of analytics. Customers loved the product, and it was growing really well. It was penetrating the global 2000 companies, the biggest companies, and customers loved the product really. The company seemed to be managed pretty solidly. It had a really low debt at that point. It was cash flow break even, so it wasn't burning cash. And the growth rate was there. It was nice, and it had and still has a really big gross margin. So it was then around 90% gross margins, which is really amazing. Now it's a little bit down, but it's still very high. So it is a good product. It is a good company. We'll talk about the management soon, but and then when I did the valuation back then, which changed a lot, and we'll talk about it, but it seemed really cheap. So at that time, it seemed to me like both a growth company, which is of course growing, and it's a tech, and of course it's a classic growth company, but it was also seemed to me like value. Because even comparing to the fair value at that point, for me, I thought it was cheap. So I bought it then at $70 a stock, which is right now I'm down 40%. Right now it's 40 after it's been up for a while, so it was even worse. So I am down 40%, and a lot has changed. And now I did a deep dive to the company again, and of course a lot of change. Then my whole investment thesis has changed, and so yeah. So let's talk about that. First of all. Yeah, the fundamentals of the company really changed and deteriorated. The company took a lot of debt since then. It took twice that, and right now it's standing on the debt of $1.2 billion, which is more than their revenue and the ARR. Taking into account that they're not so cash flow break even right now, I hope they will be in the next quarters, but we don't know. And it's been really fickle and unstable. So they're not making any cash. They're really they're not even on GAAP and non-GAAP terms, they're not making enough profit. But on GAAP, when you take stock-based compensation into account, it's they're really not making any money, and it's a lot of debt with. Which I don't know when and how they're gonna pay. Their last portion of debt that they took this year was at 9% interest rate, which is really high, and it just goes to show how much risk is involved with this company right now. And right now they're paying it $20 million a year in interest rates, which is a lot for them because they're not making any cash. So it's just it's really a problematic point, and it's really concerning. So there is the debt issue. Um, and yeah, of course, there is the cash flow issue, which I did at the time thought that at least it's not burning any cash, so it doesn't have a lot of cash needs, and it doesn't really need to raise more capital. I mean, it could for specific reasons, for specific purposes, like when it bought a company. When we'll talk about that soon, but yeah, but now it does because both. The debt was already due this year, so they had convertible notes that were due in 2023. So of course they needed to raise capital to restructure that, and then they have another chunk of convertible notes due in 2024 next year. So of course they need, but those were convertible notes at I think 0%, and now they're in debt in 9%. Of course, interest rates are up, but 9% is still a lot. And again, it goes to show how much risk is involved with Alteryx right now. So you have that, and then you have the growth rate, which of course is the biggest risk with growth companies. So yeah, we can talk a lot about the growth rate of Alteryx, but they have been growing until this quarter at 22, 23, 25% in ARR. So ARR is annual recurrent revenue, and that's the best metric to look at because they have all this revenue recognition, which we'll talk about soon, but the ARR was growing until this quarter at 22, 21, 25% every quarter for a lot of quarters, and but now they're projecting that next quarter, which is the biggest quarter of every year because all the renewals come in the Q4 of every year, they're projecting that it's going to be only 14% ARR growth, which means it's going to be for the whole year like 13-14%, even though the past quarters were okay, were good. But now they're seeing the tough macroeconomics, and they see some hesitancy on the part of their clients to spend. So yeah, so it's gonna be only 30-40%. So the growth is slowing down right now. But I do think it's temporary. I do think it's because of macroeconomics, which could be with us now. You know, there could be a downturn in the market for 2, 3, 4, 5 years. So, but I want to say they're still growing, even if that macroeconomic tough environment, which I don't think is that tough right now, and it's probably going to get a lot worse, or it could be. Well, nobody knows what's going to happen, but it could get a lot worse. But right now they're still growing, and I think 13-14% is still nice. It's the company is growing. They're nearing now $1 billion in revenue / ARR, and I think 13-40%. I know the market expects them to grow at 30% like they did in the past, or even 40% to refuel growth, but I think 14% is still nice for a really discretionary product for high tech. So so there is the growth, and we'll talk about it a little bit more in the valuation. And then one of the biggest points in my investment thesis in 2021 was the discrepancy between the ARR and the revenue, which Alteryx has. And back then, because of everything halting and at the beginning of 2020, because of the pandemic and the change of the structure of their agreements, so they had different contract durations, and for that reason they had still an ARR growth of 25% around that point, at 30% I think even, but the revenue, because it was dragging and showing what was years prior, it was like only 3-4% growth, and I thought, mistakenly obviously, that next year or the year after that there would be a correction, and the revenue would show like 60-70% growth, or even 30-40, which is true to reality, and then the price of the share would correct itself because the top line is gonna look good, and what happened was that it did happen, but the stock price did not correct itself as much as I expected, and maybe it shows that I didn't give the market enough credit. I thought, especially in the high-tech sector, that investors were mostly looking at the top-line growth, and as soon as they will see the top-line growth, and especially at 70%, which did happen, the stock price would rocket, and that just didn't happen. So it did go up a little bit, but I was just break-even at that point. It didn't go even near where I thought it's gonna go. So yeah, so that was obviously a mistake. So right now there is not this point in the investment thesis. I'm not expecting any correction in the ARR and the revenue. So there isn't that catalyst that I expect. And they have this high growth, high debt, and the growth is slowing, but it's still growing. I mean, there are companies that right now in this macroeconomic conditions, the revenue is decreasing and really decreasing, but Alteryx manages to still grow. I think that's nice. Yes. And another point that at that time I did give a rich valuation for it. We'll talk about it maybe later when we talk about valuation right now. But I'll just say that what did change a lot is the projection of net income margins, of the margins of the company. At that time, operating margins, which they expect in the long term, which they target, which is non-GAAP. We should remember that, and I always try to translate everything to GAAP, because there is a reason there are accounting rules. But they did, back 2 years ago, they projected they would have operating margins of 35%. I think they said 35%, and right now it's 25%. So they did decrease their projections of their own operating margins. I guess it's due to a combination of factors, but it has to do with them probably getting more realistic and more close to targeting profitability. So back then it was just dreams, but right now it's getting real, and they are expected to be profitable, and we'll talk about that soon also. So they should really put more realistic expectations right now, and it probably has to do with we'll talk about the cloud, which they're incorporating right now, which maybe it's just a different product mix, and it has different margins, and we'll talk about how that's probably the biggest risk with the business right now. So yeah, they really decreased their profit margin expectations, so that really changed my valuation model. And also the PE ratio, which I attached to it in my valuation model, maybe I was a little bit too optimistic, but back then it was growing like 25%, and I was still modest. I think I evaluated a 32 PE ratio, which is, I think it was okay for a company growing 25%. I mean, if you take Peter Lynch, the PE ratio, which is twice the growth rate, then it was even pretty conservative. But right now, if it's growing like that's of course the biggest risk with a growth company, where if the growth slows down, when the growth slows down, because eventually it does, then the PE ratio really cuts itself, maybe even in the biggest proportion. So yeah, so right now 32 seems really a lot for Alteryx, not only because of the growth rate, but because of all of the other risks that are involved with the company, and the credibility issues that I will talk about. So yeah, right now I think maybe like 20 PE ratio, so that does cut the valuation like by half almost. So no, not by half, but by third. So yeah, so I did touch on the financials of the product, of the company. I don't know if I covered everything, but I do want to talk about the product and then the management, and then well, we get to valuation. We will probably talk about the financial aspects more. So about the product. The product, Alteryx, is still a very, very strong product in its own field. It's kind of a unique product and is the biggest maybe player in its own field. I mean, analytics is a really wide term, and not every company in the analytics field does the same and necessarily competes with another analytics company. And it seems that Alteryx is really doing something of its own. It really has a really wide range of solutions, and it seems to me from my pretty narrow research, but that its biggest competitor are just manual work and spreadsheets that analysts are doing. So it doesn't really has that big competitor right now. It has some, maybe say Microsoft, has some tools which give a solution to some parts of Alteryx, but it's not really the same. So it is unique. The problem with Alteryx is that it's really an old-fashioned product, and it's installation and everything is really old school, and it is like heavy, and it's really old-fashioned. So they had this pressure on themselves, which it does connect us also to the management, but they had this pressure to move to the cloud for a really long time, for years, and they were denied that and saying they don't need that, and their customers are not asking for that right now, which was maybe true, but eventually they gave in to the pressure, and they obviously saw the need, and they bought a company. They didn't develop it in-house. They bought a company which did something similar, I guess, which is on cloud. And now they have those two solutions, which is their traditional on-premise Alteryx product, and they have this new product, which is cloud, and it's just it's bought. It's not exactly the same. It's a different product essentially. So right now they're really playing a game where they're sending, I think, mixed messages about what part if each of these products is playing, and which one is more in the center of their roadmap, of their product roadmap, and on which they're gonna focus. So I'm really gonna stick to one thing I've heard in one of the conference. It was a conference call. It wasn't a quarterly call, where I think Rubin, the CFO, has said that right now they're focusing on all the new features, all the advancing features. They're gonna do more in the cloud, and on-prem, of course they're still developing that and releasing new versions, but it's more of maintenance and more features that are more for the infrastructure, maybe permissions, stuff like that, that allow that there are some new features that customers are asking for, but it's not like advancing the analytics field further. It's more like infrastructure stuff. He did say that. I think they said different things in different calls. Maybe it would be worthwhile to just look at some release notes of the versions. But yeah, I think this is a really big issue right now, because there are some new clients that are going to the cloud. There are some new clients that are going to the on-prem, because the on-prem is still the biggest product. It has a wide range of solutions. It has all these features, all those capabilities, which the cloud doesn't have. It's a thinner product right now, and they are investing in it and trying to broaden it. But we should remember that it's not their own product. I don't know how it's going with developing. I mean, they bought the company with the employees, of course, but it's always the integration is always difficult, and there is some risk to that. I think the biggest risk with the cloud is, of course, the profit margins, because we don't know right now, and no one is talking about it, it seems, what the profit margins on the cloud are going to be. And it can really, if until a year, 2 years ago, they had 90% gross profit margins, which is really, really beautiful. We don't know how it's going to go with the pricing, with the cloud, and the margins. And that's a huge risk, because even if the company does grow 30% a year, if your profit margins are eradicating or just decreasing, it really affects the valuation of the company. I think another huge risk, I honestly think those are the greatest risks with Alteryx. Another huge risk is that they're pushing all their energy into the cloud right now, which is not the on-prem Alteryx. It's just another product which doesn't really deliver on all those solutions. And maybe it won't be that good of a product like the on-prem was a few years ago. And maybe it's just a matter of time. It's always with tech a matter of time until a new product emerges, which is innovative and new and light and just simplifies everything and does in a friction of energy and effort twice the job that the old product did. So of course it's a risk with every technology company you invest in, but I think right here the risk is even greater, because this cloud, which is their new, supposed to be more innovative and more new product, is thinner in terms of the solution it gives. So its moat is much smaller, it seems. So it is, I think, a great risk with Alteryx. So that's about the product. I would say the customers still really love the product. I don't know about the cloud, but I think it's mostly with the on-prem. It does still give very good solutions. I read some reviews of users across the internet. They really love the product. I think the net expansion rate of 130% really speak for themselves, both in the Global 2000 and small customers as well. They really love it. They always they have this land and expand model, which they first sell just a few users, just a few seats, and then companies do love it, and they see the benefit of the product, and they really enjoy it, and they expand. So we'll see what goes on with the net expansion rates in the next quarter, because if they even report it, because they do expect for the first time Q4 to be slow. So it must reflect on the expansion rates, although it didn't last time. So we'll see. I don't know, maybe it's not completely as we think about it. I don't know. Yeah, that's about the product. Yeah, the cloud kind of scares me. I think the future is really unclear with it. One thing I will say, and another thing about the product, is that it's really expensive, and I think just goes to show the big moat Alteryx has when the product is expensive, and they're managing to raise prices even more. They've been decreasing, almost eradicating discounts for the last 2 years, and it's been successful. They were still growing very nicely, even with rising prices in a tough macroeconomic beginning, we'll say, of a tough macroeconomic environment. So it also really goes to show for the strengths of this product, in my opinion. So this is about the product. Yeah, now about the management, which is a really tricky one. So yeah, management of Alteryx. Alteryx changed all of its management 2 years ago. They changed the CEO. The CFO was the only one left, and they brought a new chief revenue officer, and all the level beneath them was also changed. Yeah, I don't know. I don't like very much the management of Alteryx. I think they've been very inconsistent, we'll say, with their declarations and their commitments. And it just seemed all over the place, honestly, with their targets. So if I talk about at first how it was even before the current management, but how they for years said that that they don't need the cloud, and the customers are not asking for the cloud, but eventually, of course, they need the cloud. Everybody's going to the cloud, so they should too. So they were kind of in denial, but it was before the current management. But even now, when I look at the past 2 years, I mean, it's been so many like different points. So, for example, when the downturn in the economy started, they were asked a lot of times what's going on with that and how do you feel about the economy, and they were always sending those. They were not even sending messages. They were clearly saying that no, we're great. The macroeconomy may go down, but Alteryx is such a unique product, and you'd be surprised to know how much Alteryx helps customers even more in difficult times. So they were like trying to sell Alteryx as this consumer staples product of high tech, which is, of course, it's not. And of course, Alteryx, analytics, those. It's super nice to have product. It's not the first product a company is going to invest in difficult economic times. And when a company is cutting its costs and restructuring its expenses, of course, one of the first things that are going to go out the window are solutions and projects like analytics. So I don't know how they were thinking that, or I don't know if they were really thinking that, or they were just saying that, but the whole economy was already going down, interest rates were up, all the big tech companies were firing and decreasing their expenses, and Alteryx at that time was expanding itself like crazy. It doubled its workforce. It hired, I don't remember how much, but it really doubled their sales force, their sales team. So it hired so much, and it grew its expenses so much. And those are not just salary expenses, those are stock-based compensations, which went through the roof during this time, when everybody around was cutting costs and firing, and it was really weird to see, but they were at the time still growing, so you didn't really know what to think, although it was kind of obvious that it's not sustainable. And then one quarter, suddenly, everything is going down, customers are cutting spending, customers are hesitant to close contract with us. Of course they are. Everybody's, I mean, the fear factor is through the roof in the economy. And everybody is holding tight to their budgets right now to see where things are going. And everybody is in shock because of the interest rates that went up after a generation almost of low zero interest rates. So, of course, everybody is tightening their budgets. And it's going to, of course, reflect on Alteryx. I don't know how I think it was really reckless, honestly, to expand their workforce so much and expand their expenses so much in those times. And suddenly it all blew up, and they realized that their growth rate is slowing and contracts are not closing, and they built this whole story, which was I do think that was not really credible, about how renewals are still okay, but they really tried to, maybe it was true, but they put so much emphasis on how renewals were okay, but new sales or new expansions that are not attached to a renewal is only there. The problem is like, it's not a problem, it's also a problem. What does it matter? They see that the customers are tightening their budgets and they're willing to expend less, and even if they do close the contract, it's going to be on less, and they're not going to expand what they previously planned to expand, or maybe they're even going to tighten what their current contract. So of course it's going to happen. And then when they realized that, they suddenly began to fire people and to shrink in their workforce. So it was really a mess. And I only want to believe that they brought on new people to to like support the new phase of the company, because it is growing. It had a lot of growing pains, and the DNA of the company is going to change when it's growing so much. And of course, you need a different skill set. And Mark Ederson, the CIO, said that in one of the last calls, and he's right about that. I mean, you need to have different set of skills and different set of experience and different set of mindsets when you're dealing with a 1 billion company, which now aims at bigger customers also, which I haven't mentioned, comparing to the older Alteryx, which was more focused on smaller accounts, and of course it was smaller, and everything is changing. So I want to believe that they brought on new set of skills, and maybe the people they let go of are the older that do not deliver as well in this environment, in this new era of Alteryx. But I don't know, it's just wishful thinking, honestly. Just hired a lot of people in the times that the economics was going down, and now they fire a lot of people, and now they're in the last quarters they're decreasing their expenses, or they are also firing, and they're doing all those initiatives to decrease their expenses. So now they're looking into profitability. So let's talk about that. So of course Alteryx is going to go now for a profitability for a variety of factors, and soon we'll talk about the most important one. But of course the environment is changing. All the companies which were growing and showing zero profits and crazy losses are now expected to show a little bit of profitability, because we're hopefully finishing with that maniac period in the market, and now companies are actually expected to be profitable, which is unfathomable, and they're of course experiencing that too, both from the Wall Street and investors, and so they are targeting profitability right now, and when their growth rate is slowing, so they're going to focus more on profitability. That makes sense in the type of environment. Of course, you need to control your expenses more, and that's all natural. But the most important thing is the change of incentives that occurred in the management of Alteryx. So for years, their incentives, their compensation was of course the base salary, and then they had some bonus, but the biggest chunk of compensation was based on targets. And until March of last year, the target was only based on ARR growth. So as long as they managed to achieve the ARR growth that the board of directors has set, they received the biggest chunk of stock-based compensation. Last year, maybe it was even 2 years ago, the board of directors, a part of the company not managing to grow, not managing to recover its stock price, and it always seems to be another problem with the company. They met, which was a really good initiative. I don't know if that's something that's customary, but they met with their biggest investors and heard what they would like. So what changes would they like to do in the board of directors? And the biggest things investors said were the compensation of the management, of course, because they're only measured on ARR growth. So ARR is growing while the stock price is going down, and all the financials and the fundamentals of the company are deteriorating. So of course it doesn't make sense. So they changed completely the compensation structure of the management, and since March last year, they mostly based it on the stock price, which is really great for us shareholders, to the point where Mark Anderson, the CEO, has zero compensation other than the stock price. I think he has the base salary, but he has no other stock-based compensation, only based on stock price, and that's really great. And it occurred more than a year ago. It was March, not this year, last year. But I think that really changed the focus of the management, of course. So now I think they will do their best to not only grow ARR, or even not grow ARR at all, but grow the stock price. Of course, they need to grow the ARR to grow the stock price, but it should be a combination of both growing the ARR, or growing the revenue of the company, and managing it still solidly and still with the responsibility in terms of debt, in terms of cash flow, in terms of stock-based compensation, which is through the roof, and interest rates, interest payments, everything. So they're gonna have to be more mindful and manage the company with more carefully. And I think that this fact, that the fact that the company now and the CEO and all the C-level management is now interested in the stock price to go up, that really makes me more optimistic about Alteryx and their behavior. Although I do think that some damage was done that I don't know if they can fix it that easily. But now they will be mindful about it, so that's nice. So that's a big point. That's really one of the big maybe points right now to in the investment thesis of Alteryx. But yeah, overall, the management doesn't give me a really good impression. I feel like they're not transparent, and we always need to read through. Of course, we always need to read through the lines, but here it's extra, extra, extra. And I think they're I don't know, they're building these stories, which I don't know if it's not that they're untrue, but they just seem to distract from what really matters. And I don't know. So yeah, I'm not a big fan of the management, but I do like the product, and I do like the company. It seems I also see that the employees are saying that they like the product, that the customers like the product, and maybe that is a classic case of like Buffett said, that buy a company that any idiot can run, because at some point one will. So I'm not calling anyone idiot, but you get the point. I would prefer to hold a good company with a bad management than a bad company with a good management, because yeah, the management can improve and they can be changed, but even with them, I mean, they did some good things also, yeah, but even with them, the company is still growing and it's doing really well. We haven't talked about how well we did, but they always say that Alteryx is in such a rut and it's such a bad phase, and it's going really bad for it, but it's growing really nicely. So I don't know if the management is all credit for that. Maybe it's just the product that really sells itself also. But the expansion rate, which is really high, it goes to show how much the product does sell itself. So yeah, so this is about the management. They're always talking about the profitability, the efficiency of the sales process, which really I kind of got tired of it already. They have always this story that right now they're working on improving the sales process, or they have all those catchphrases for sales efficiency, and right now they're seeing some bad signs about the sales efficiency, but they're working on it, and just in the quarter 2 or 3 it's gonna improve. And this is a story they're telling for years now, and yeah, maybe they're saying it does improve, but they always when there's some bad news, they say, oh, we see a problem with our sales efficiency, with the sales productivity. And yeah, we recognize some problems and we're gonna fix that. And maybe that's true. Maybe, when market conditions change, you need to change your sales strategy. That makes sense. But I don't know. It's just, I don't know. Something feels untransparent for me about the management. So yeah. So that's about the management. One thing I would mention, which maybe is one of the biggest things about Alteryx, is that there are a lot of rumors, and it seems that the company is up for sale. So we don't know, of course, we'll never know until we get the announcement that it was sold. But it does seem like, and it cannot go through, of course. So the company might sell soon. So I think they're also cleaning up the financials and everything, the employees, everything in the company, the cost structure, and the refinancing the debt, everything. Of course, they have to because it was due, but because they're preparing it for a sale, and I don't know if I like that or dislike that, because I am really in the red with Alteryx, and I was kind of hoping to make it through the bad times to the good times with it. And right now, if it sells, it might, I don't know if it's gonna be for a lower even price than the market price today, because it does have problems and it does face a lot of issues in the last years, and it does have a really high debt right now for I think so, and the growth is slowing, so it does face some really big issues right now, which not the debt, but the rest of them can be temporary, and if it sells right now, it can be from the point of despair, like, and it could be for a low price, but I don't know if the board will approve of that. On the other hand, of course it can sell for a premium, like a lot of companies sell for a premium, which still won't bring me to my cost basis, but that's okay. I'm not hoping for that anymore. I'm looking at the price right now and where we're going from here. So yeah, so it's up for sale. So it's important to notice that, although I don't know what to do about it. So yeah, so let's talk about valuation, which is probably the most important. So I basically think there are two scenarios, and I'm not going to take an optimistic scenario with Alteryx because of all the risks that are involved with it. I'm going to make a probable and a pessimistic scenario. So the probable one is that it's gonna keep on growing. It's gonna grow for like 13-14% in the next 2 years, for example, and then it's gonna manage to accelerate its growth when things are better, hopefully. And then the PE ratio would also correct itself when the growth is back on track. And right now I'm projecting a net profit margin of 13%, which even now I'm not sure. I mean, it's in 2 years ago when I was evaluating it, I gave it 23%, and now I'm giving it 13%, and I'm still wondering if that's conservative enough. Maybe not. So that's really a problem. I think that's the biggest risk when you don't know. Of course, not knowing the expected outcome is the risk. So yeah, so in the probable scenario, if it grows for like 12% next year, and then 40%, 80%, 20%, 20%, and then the growth will slow again to 80%, 15%. I don't know if that's probable right now. I think that maybe that's a little bit too optimistic also. Then I expect the stock price to be around $50 in 2 years, and then $70 in 3 years, and $90 in 4 years, which make it more than a double in 4 years, which is nice. And it gives me a 24% return annual. So that would be nice. I'm talking about from current price, of course, of $40. In the pessimistic scenario, which also right now I'm looking at it and I'm not even sure if it's really that's pessimistic. I mean, it could be really worse. I mean, customers could churn and revenue could even go down. So, but okay. Again, that's the big risk with Alteryx that you don't know, and that's the risk with growth companies, that projecting the growth is the biggest factor in the valuation, but it's the most unknown and you cannot count on it. And if the market goes down, of course it can really go down. So, but yeah, we'll go with that. So in a more pessimistic scenario, it would grow 12% next year, because that they're pretty much implied right now that that's what they're expecting. And then 9%, 12%, 40%, 15%, and 13%. Just mid tens, low tens percent each year, which also, again, it could go worse, of course. But in that case, the stock price would be in 2 years $30. Which make me even more in the red, and then even lower, it would go to $27, but then it would recover to $46, $58, $78. So that would give me like 8% annually within 7 years, and that's not good enough. Of course, I can right now invest in T-bills and have my 5%, 5.5% of certain return. So that's of course not good enough. Yeah, so I need to process all that and to make a conclusion. It's really, really risky investment, and I really don't like it right now. Would I invest? The biggest question every investor should ask themselves when they review an investment is, would I invest in it right now? And the answer is no. So that's as a signal I should sell, but I think I'm gonna wait another quarter just to see Q4 how it turns out. I think they were a little bit very over conservative, I suspect, in the projections in their of their Q4 with I mean their annual results. I think they right now they are looking very hard at the stock price, and they don't want it to go down anymore, because it's been years now that on most of conference calls or press quarterly releases, the stock really fell, and they don't want that anymore because now they're skin in the game. So I think it might be a little bit on the conservative side. They were growing really nicely until now, so we'll see. We haven't seen the the growth slow still. They're just projecting that. Until now it was fine. So I think I need to see really the things deteriorate. I mean, I am in the red already really a lot. I don't think it's gonna fall to like $15 now. It can always happen, but I think I can. Right now the upside is a little bit bigger than the downside, I think. Even not a little bit. I think it's really the upside is bigger right now, because the management does want the share price to go up finally, and the company is growing. The expansion rates are good. The customers love the product, and they're focusing on profitability now. So I think there are reasons to be optimistic. Of course, on the other side, the debt and the incredibility and the cloud, which we don't know where it's gonna go. So yeah, I think I'm gonna just wait another quarter to see what's going on and decide then. Yeah, would I want to keep that company for 10 years for my family to depend on it? No. So that means I am looking for a good point to sell. If I had right now a better investment, of course, I would just sell, and you don't have to make back the money you lost in the same stock. You can switch it to a more safe place and make even bigger return, or a safer return there. So yeah, I'm just gonna wait another quarter to see and decide then. Maybe I will sell a part of it, because I do think there's a big chance it's gonna rally. And when even the prices, I said, of course, the fair values in a few years, I said, of course, they're just fair values. But if the stock recovers and the confidence in the company recovers, and then it can go through the roof, because the market tends to overreact, whether it's when the price is going down or where the price is going up. So yeah, I'm gonna wait a little bit on it and see where it goes in a quarter. So yeah, bye bye.